but I don't know if that's going to fill the medium term issues. It's just going to make the spot market tighter. But the problem is at the next level of long term contracts, who do you sign them with? Who's got that capacity to guarantee that you've got 3 to 4 years of whatever X amount of uranium coming to your plant? If it's not coming from Kazakhstan, and then can the Australians provide it? Can the Canadians provide it? I know that Cameco is trying to restart a lot of their operations, which requires capital, but that it's easier to restart some of these operations than start a greenfields project right now. So if they start making uranium a critical mineral, then the Department of Energy starts funding it. I mean, I know that they were looking at stockpiling. That took a long time to get legislated. That took a long time to execute. But I don't even know if that's enough.
I'm its founder and its host, Gary Bohm. Uranium prices have doubled in the last year, and investors want to understand more about capitalizing on the uranium space. Gold is projected to hit a supply cliff in the next few years, and copper as well. Silver demand from applications such as solar panels and electric vehicles is beginning to surge. Meanwhile, the miners have taken a beating over the last 18 months. To discuss all of this and more, we are so fortunate to sit down with Joe Mazumdar, owner and analyst for Exploration Insights, former senior mining analyst for Canaccord Genuity, Haywood Securities, and Freeport McMoran, and having worked in multiple capacities for mines such as Newmont Mining, IM Gold Corp, and Rio Tinto, among others. Joe, thank you so much for joining us today.
Thank you very much for the invite.
Yeah. All right. So, I want to start at the macro level. What is your take, Joe, on the current economy and the stock market? Is it fairly priced, underpriced, or in a bubble?
On the macro, on like the S&P 500 and the NASDAQ?
Yes.
Yeah, I mean, we've been saying it's been overvalued for almost a year and a half or so, and it just keeps going up. So it's hard to fight those 4 or 5 companies that are making everything go up. And, with this artificial intelligence, I think that is real in terms of what people are looking for in terms of development and the efficiencies. The problem is on the other side is, people are seeing that there might be nothing else to invest in, and that might be their go-to. But now with interest rates, when they were going up, people were looking at taking money out and just leaving it there in a bank account that might suddenly make some interest. And that was problematic, should have been more problematic for gold last year. Gold should have actually gone down last year, but it didn't. And the reason it didn't, because central banks all around the world were diversifying and buying more gold with their US dollars. And that made gold go up 13 to 15% last year in an environment of increasing real rates. But that, because the underlying demand for that was central banks and not investors, like institutional equity, what have you, that didn't spill over into equity. So equities didn't do very well. But I'm not so focused in on the macro S&P 500 and NASDAQ. I'm much more focused on the resource equity side.
Yeah, and I appreciate you answering that question. I just like to get an idea where people think we are with the markets and the economy. So let's turn to the resource sector. Specifically, we'll start with uranium. Recently, Kazatomprom publicly stated that they're going to miss production estimates for at least the next 2 years. Yeah. So, from your perspective, what is the impact of them missing? And is there a possibility that the reason they're going to miss is not due to what they said, which was the acid issue, but rather maybe mine depletion? And if that's the case, where do uranium prices go in your estimation?
Well, I mean, uranium with a background was depressed for the longest time since Fukushima, the tsunami and the nuclear power plant. which at that time I believe uranium was trading over $70 per pound, and since then nobody wanted anything to do with uranium and nuclear power plants. And then what was happening was some of the stockpiles that the Japanese had held, because usually all nuclear power plants would have a stockpile ready to feed the nuclear power plant. They were pushing that back into the market. They didn't basically commit to a lot of these contracts they had with Cameco. So there was more and more stockpile out there. Unfortunately, uranium's not a visible market, so it's hard to know where the inventories are. But those inventories sat on top of the market for years, and that's why everybody was buying everything from spot, and nobody was signing a long-term contract. So those long-term contracts did not incentivize anybody to do anything. And now what's changing is that the market been so depressed for so long. I mean, we've seen these ETFs come up and start buying physical uranium in the market. So that was cleaning up the spot market. And as the spot market got cleaned up, when you have issues like shortfalls of production with Cameco at their facilities in the Athabasca Basin, whether it's Cigar Lake or another one, and then the news with out of Kazakhstan that they don't have enough sulfuric acid, and they might not be able to meet their production not only for Q4 last year, but projecting forward. And then another issue with Kazakhstan, it's landlocked, so it's isolated. It's hard in terms of supply chains, but also some of these assets, uranium assets, are joint ventured with the Russians. And now with the U.S.'s foreign ownership, I think foreign owner of concern, the Russian and those sort of ownerships, 25% or more by the Chinese, the Russians, North Koreans, or the Iranians, would not get into the market, potentially into the U.S. So that's segmenting. So one thing is the overall supply and demand. Demand seems to be pushing up because of this carbon neutral society we want, and the push to triple nuclear capacity, according to the COP28. So you got that demand pull. And then on the other side, we've almost eliminated the overhang of these inventories, and now spots being cleaned up by these ETFs like the Sprott one. And then the production is actually not coming in the way we suspect. So all of that is good for prices, and that's probably what prices are telling you right now. That's why spot is where it is, over $100. The question is, where do the long-term contracts come in? Do the long-term contracts that these development projects need, do they incentivize people to build? That's really the question. You have some of them that can bring on incremental production and stuff like that, but those guys that need 65 plus to build, will those contracts get signed?
So, but even if they build, even if they're incentivized to build, it takes quite a long time to bring uranium product out there. So we're going to have this supply deficit that you're talking about for quite a long time, even if they started to act on that incentivized price today, right?
Oh yeah, I mean, it's not only construction, but it's also funding. So a lot of these projects will, especially in the western part of the Athabasca Basin, that's not where the infrastructure is. It's on the eastern side. So all the plants are on the eastern side. And so you would have to, and between next gen and fission, they could potentially generate enough pounds together to incentivize somebody to come in and build that plant. Because I don't think either companies' management teams are set to build anything. But, who's going to do that? I mean, Cameco has basically put their money into more downstream in Europe to take over from the Russians there, making more enriched uranium, which would be, where their source of U3O8 would go to themselves in Europe. So they've, got a pipeline there. They didn't buy a development project. So that was interesting. And now, with this foreign ownership issue, I don't think the Canadians are interested in the Chinese coming in and building these projects at all. So then who's going to come in to build these multi-billion-dollar uranium projects? That's another big question mark out there.
So with all the question marks and all the time, the elongated time it takes to get into production for a mine, and seeing production shortfalls like we're seeing from Kazatomprom and Cameco, the two largest, what's the likelihood of bringing equilibrium to this supply-demand problem that exists right now in the next even 4, 5, 6 years?
Well, it's not going to come from aliens landing on the planet. So, like the one thing that's nice about mining is it's easy to see how the supply side, because the supply side needs funding, it needs permitting, it needs construction. There's no, it's hard to compress that timeline. The question is, what does the demand pool look like? Knowing that that you can't get that supply, does that mean you don't build the facility? That would be the question. And then the other one we didn't talk about was Niger talking about changing mining licenses, exploration licenses. So future stuff can't be found. That's another positive sentiment for the price from another lack of supply, future supply. So yeah, it's all set up to look good for the uranium price, but it's how you play it is interesting, and that's why a lot of people have been playing it with the ETFs and the physical uranium as opposed to the companies, because even though you said like uranium was up 80+%, uranium equities, the ETF wasn't up that much. So people saw more leverage to uranium by buying uranium than by buying the equities.
Well, that's a really good segue because I was going to ask you a very similar question. You had brought up Cameco a moment ago. So speaking of Cameco, because they have a lot of forward obligations under contract, their earnings have limited upside to the higher uranium prices over the next 3 years. While the sensitivity of realized prices depends on how the book of forward commitments is structured, Cameco did provide estimates in their third quarter report. And it showed that even if uranium were to spike up to $140 a pound and stay there for 3 years, they would realize prices only between $50 and $73 a pound because of the forward obligation. So it seems like Cameco has very limited upside. So instead, do you personally prefer owning the metal directly through a vehicle like SPUT, the Sprott Uranium Trust? You prefer owning a company that's not burdened under contract obligations at lower prices, such as UEC, Uranium Energy Corp? Is there another type of structured company you like altogether, or do you still like Cameco?
Well, I never said I like Cameco, but I would say that if you, but the same thing happened on the other side. So when uranium was dropping, some of these companies were actually selling uranium at a higher price than the actual uranium price because of the long-term copper price. And now, like you said, we're seeing the problem on the other side. And the other question for Cameco is, are they actually buying their own stuff that goes into Europe? So if they're buying their own stuff, then it's just an internal issue between themselves, because their big value add is producing the enriched stuff. That's where they're getting the value add because they feel that there's more play in it for them to do the downstream and take over from the Russians. That's more of a long-term play. But definitely with we've seen this before with companies that you see that the commodity is going up and they should provide leverage, but they don't because they're not set up to grow like that. Nobody is. And also, I talked about this in my last presentation at the Metals Investor Forum about the lack of leverage on the gold side as well. So, when we look at the all-in sustaining cost margins for some of these companies, they're actually shrinking. So as the gold price has gone up, it's done very well, but their costs have gone up almost in parallel. And then, even though they were saying that, on the sensitivity analysis a year or two ago, that if I increase my reserve price $200, I'm going to add like whatever 10 to 15 million ounces. And then the results come back that, oh, I've raised my reserve price $200, but really my reserve price, if it weren't for an acquisition, would be just basically about flat. And then my costs have gone up significantly. And part of the reason the costs have gone up is because I'm bringing in a lot more low grade stuff into my portfolio, NPV, net present value, $1, that gets in there now. And so my costs are going up, my margin's going down, and I'm not generating the kind of leverage that I thought, either from the reserve point of view or even from the cash flow point of view. And so that is an issue for companies when the gold price does go up. Is do they actually reflect that in their margins?
So, do you suspect that from the gold standpoint, if and when the gold price moves, we may see a similar flatlining in the equities as we have with the uranium equities?
Well, with gold specifically, that was happening in the latter part of last year. And one problem was the people that were buying gold were not the people that would have ever bought an equity share. So if institutional equity is buying gold ETFs, and you see that in the ETF inflows, that spills over into gold equities. Then they start buying Newmonts for dividend or Barrick, and then they start going downstream, and then intermediates, whatever. That doesn't happen for a central bank. A central bank is solely interested in taking those US dollars and making them gold. Yeah. They're not interested in anything else. The other problem was exactly what I said in terms of changing reserve prices and bringing in lower grade, higher all-in sustaining cost ounces. And then you're cutting back your margin. If you keep your reserve price the same now, then hopefully you can see that leverage going forward. But if you keep raising your reserve price, you will probably have a negative impact on your all-in sustaining costs.
Interesting. All right. So just quickly staying with the uranium space for a moment. The United States is working on supplying its own uranium for existing and advanced nuclear reactors that could become commercial in the future to reduce dependency on Russia for the fuel. So we still rely on Russia, as you know, for approximately 50% or so, including powering the nuclear power plants. So they're developing this strategy that's going to eventually include a uranium strategic reserve, banning the imports of Russian uranium, and making sure that the U.S. can fuel its own reactors, implying domestic sources are going to ramp up hard.
Yeah.
So in 2012, the total U.S. production of uranium was shy of 1,600 metric tons. And in 2022, it was only 75 metric tons. Yeah. So the production really needs to ramp up hard just to get back to 2012 levels, let alone to service everything 100% or where we don't rely on Russia anymore. My question is which American uranium mining companies are the closest to production that's going to be able to help America meet their uranium goals of independence?
Energy Fuels.
They're the closest?
Yeah, they've got the most permitted capacity. And they also have a permitted plant, White Mesa, and they have some ISR mines, in situ leaching mines. But, I doubt if even they would ever be able to fill the gap for the production coming from Kazakhstan. Because if you're a nuclear reactor, and you have somebody who's handling your supply chain, his incentive is to buy the cheapest uranium he can get. And the cheapest uranium you can get is the lowest cost uranium. And that tends to be the ISR coming out of Kazakhstan. He doesn't care where it comes from as long as it comes and it's cheap. But if you're obliged now that you have to buy higher cost uranium, which is all the US stuff is higher cost, then your costs are going to go up. Then your energy costs are going to go up. And so consumers are going to get hit by that as well. because it's going to flow downhill. I can tell you that. So if people want to implement these strategies of segmenting the globe, they're going to feel it in their bottom line with respect to how the capital markets work, because you're no longer feeding yourself the lowest cost stuff. You're feeding yourself potentially the middle cost to higher because you have to, because the other stuff is not available to you anymore.
So 2 points. The first one being, do you expect these policies to get passed in the United States government, or because of what you're talking about, you don't, that it's more gamesmanship? And number two, and you could speak onto it a lot better than I can, but I'm under the understanding that the fuel costs for nuclear reactors is very small in comparison to the overall cost structure, and that even a rising price into, say, several $100s a pound for uranium isn't going to impact the electricity cost for the consumer that much. Can you speak into both of those?
Yeah, I mean the thing is that may be true in terms of the overall cost, but there are people that are concerned whether there'll be enough supply as well, because I think that's probably a bigger issue. Like, not only will be upper on the upper set of the cost curve, but there just might not be enough, because if you take a whole bunch of stuff from the lower part of the cost curve and say you can't have that, how do you replace that? Mm-hmm. Some of it you can replace with the high cost stuff, but there's still, in terms of overall production, the idea is to get that from Australia and Canada, but Canada infrastructurally, those projects need to be built. And technically, they're not easy projects in terms of, freezing the ore underground so you can mine it and all this other stuff. Mm-hmm. They're high grade, technically difficult, and high cost. Australia stuff, that might be easier. A lot of that stuff, I believe, probably might have been going to China anyway, and maybe they'll switch. But Australia and Canada are the ones they're probably the most dependent on, because even though the U.S. has some capacity, it's limited. It can't make up for taking away a lot of the production from places like Kazakhstan.
So what I hear you saying is that even if Energy Fuels is able to ramp up to what their projected amount is, there's still going to be a deficit if the United States government is expecting us to not rely on any Russian sources, and therefore the difference is going to have to be made up by either Australia or Canada. There'll be more pressure on that.
Yeah, unless they sort of say, "Oh, yeah, well, you can have some. You can, it just comes through anyway."
Yeah.
Because we all know when, Russia was banned in terms of all its metals, minerals, and oil and gas. All that oil and gas still made it to the market, but it went to China and India. The nickel and the palladium still made it to the market. It just went to a different market.
Mm-hmm. Okay. Final question on uranium. Do you believe that at some point that the U.S. utility buyers are going to be forced by these supply constraints that we've been talking about to approach the various financial vehicles, including Sprott's physical uranium trust, to seek uranium that they need? And if this does happen, won't they likely be forced to pay extremely large premiums above the current spot prices at the time to secure the long-term supply that they need? And secondarily, if this happens this way, do you believe that this could mark the top of the uranium bull market, or do you see the top in this bull market happening differently?
Yeah, hard to know if they're going to, go, because in the end, that's what those guys want, is they want to sell it to recognize, the gain, like something like Yellow Cake. They bought physical, and they probably want to sell it eventually. And if they made a double or a triple, they're probably well incentivized to sell. But I don't know if that's going to fill the medium-term issues. It's just going to make the spot market tighter. But the problem is, at the next level of long-term contracts, who do you sign them with? Who's got that capacity to guarantee that you've got 3 to 4 years of whatever X amount of uranium coming to your plant? If it's not coming from Kazakhstan, and then Can the Australians provide it? Can the Canadians provide it? I know that Cameco is trying to restart a lot of their operations, which requires capital, but that it's easier to restart some of these operations than start a greenfields project right now. So if they start making uranium a critical mineral, then the Department of Energy starts funding it. I mean, I know that they were looking at stockpiling. That took a long time to get legislated. That took a long time to execute. But I don't even know if that's enough.
So it sounds like even if they were with the supply deficit, even if they were to tap yellowcake and sput at absurd prices, that still may not be enough to correct the supply demand imbalance. It seems like you're saying we're going to be in this imbalance for quite a long time.
Yeah, especially if they keep to that idea that, we can't take stuff from Kazakhstan. I mean, I'm not even talking about their shortfalls of production. So assuming everything's the same and, we don't have this foreign entity of concern, there's still a production shortfall. That could be filled with a strategic stockpile, potentially taking off of, the Sprots and the Yellow Cakes and whoever else is out there. But the long term, the medium to long term, and all this nuclear capacity that's being brought on, where are those contracts being signed and with whom? I mean, even though China doesn't have an issue with, where they get uranium from, the problem is they might not be able to get uranium from places that they would have liked to. Because they probably would have funded some of these projects in the Athabasca Basin. They would have provided the capital to build. But now their capital is not wanted there.
So, we've all seen the chart of the uranium price spiking up in the 70s, coming down into that bowl, going back up in the early 2000s, and then after Fukushima coming back down, and now it's on the way back up again. Am I correct in assuming, I don't want to speak for you, but you don't see this spiking up and coming back down this time? It may level off some, it may fluctuate in there, but you see elevated uranium prices, barring maybe a nuclear accident or something, an act of God like that. You see elevated uranium prices for years to come.
Well, the thing is, like when uranium was problematic, when we had higher long-term price contracts, and then spot being much lower. And that's why no long-term contracts were being signed, because people were pretty comfortable that there was enough out there at lower prices that they didn't want to get committed once again to a long-term contract at higher prices when they could get it from spot. Problem is now with the supply, they might not have enough spot to get it at whatever price they want it at. They'll have to sign long-term contracts. And then the problem is, how does this foreign, entity of concern work that I cannot now sign this contract anymore? I can't renew this contract anymore. Because right now, maybe as a nuclear power plant, I'm worried I might not get the commitment from Kazakhstan that they owe me, and then it'll be forced. Kazakhstan will have to buy the uranium from the market, from the spot market, or from these ETFs or wherever. It's because it's Kazakhstan's issue, because they're committed to get me the uranium at this price, but then going forward, can I still have this contract with this Kazakh company? Can I or not? And then where do I get it from? So it may not be an issue that there might not be enough supply in some respects, in the middle term. But, if you tell me I can't get it from there, then that could be a problem. Then I'm going to have to go rushing around looking for new sources of supply and start signing contracts. But then I'll have to incentivize some people. Then I have to be happy, not happy, but, satisfied that price that I'm putting at is a long-term price. And so when they start signing those contracts, those guys know better than me what they're willing to pay, what they think the long-term is. So that the way they manage their contracts will give us a good idea where the market is at because they see a lot more than me. I'll give you an example. So you said I worked for Freeport. I actually worked for Phelps Dodge before Freeport out of Phoenix, and we would do M&A. And when I worked in the markets, the commodity markets there, I worked in copper and all these other markets, but I also traded physical commodities. And so whenever we did an M&A, if there was a commodity that we didn't know anything about, I was tasked with finding more about it. And so once we looked at buying this one company called Western Mining, which BHP ended up buying, and they had this huge deposit, still do, called Olympic Dam. And that was in Australia. And that had a huge uranium component that we had no idea about. Interestingly, Phoenix has a nuclear power facility right nearby. And so with the contacts that we had, be Phelps Dodge, we talked to one of the guys who purchased the uranium. And at that point, uranium was trading at about, I don't know, about $5, $10 or something like that per pound. And he basically told us, like, there's no way the price ain't going to 50. And I said, Jesus, I mean, where the hell did you come up with that number from? And that's exactly what it did. Because they saw the market much cleaner than we do, because it's not a purely visible market like some other commodities. In terms of where the supply is, the demand, where the inventories are all. It's a little bit more opaque. So for somebody who sees the market as well as they do, because they're actually purchasing the uranium, that for me is the greatest indication of where we're heading. And so that's what I want to see, is what terms are they giving to these contracts? What kind of prices are they giving? And are they incentivizing these guys to build projects, let's say in Western Athabasca Basin, or restart projects and start projects in the States?
Great point. Really enjoyed the story too. I would like to shift over to gold, if that's okay with you.
Yep.
A review of the top 20 global gold producers and their projected production from proven and probable reserves actually shows that there is a gold supply cliff that's headed our way. It's coming fairly soon. It's set to begin around 2026. And after 2029, the chart just literally drops off a cliff. At the same time, like we were discussing earlier, global central banks are buying gold in record numbers. They're settling trade more and more in gold instead of US dollars. And they're choosing gold over treasuries more and more. And to make it all worse, the US government is running up these massive deficits and debts, which imply that there's going to be big purchasing power loss for the dollar coming at some point. And this all seems to be setting the stage for a supply and demand picture, maybe to look similar, but not exact, to the uranium supply and demand situation. I know it's different, but there's some similarities there. Can you speak into gold's anticipated supply and demand situation and what you see for gold prices over the next 1, 3, 5 years?
Yeah, the difference in gold for me is one the mines produce a fungible product. They produce a product that can be sold, to a bank, to anybody. They don't need a buyer. Uranium, you need to get a buyer. It's got to go somewhere. The other problem for gold is it's not a marginal cost industry. The cost of an ounce of gold doesn't matter because I could buy it from a bank. I don't need that. I don't need to get it from mine production. But the thing about the gold price is it's definitely more of a financial product. And so historically for me, just looking at the direction of real rates, not the absolute, but the relative trend in real rates, it basically dictates what that gold price is going to do. So when we've been rising real rates, even when gold, when rates were negative and they were looking to go to 2%, that's when gold went down. It didn't matter that they were right now negative. The idea was that they weren't going to be negative for long and they were getting positive. Now, but I mean, in the last part of the last quarter of last year, people were thinking, okay, real rates have peaked. It's going to go down. We're like at the equinox of real rates in this cycle. So we got to buy gold. And so that's where we saw probably more equity ETF inflows. We saw some push in the equities. But now, because we're getting these numbers out of the States that the economy is actually growing, looks like a soft landing, and inflation is moderating. So the personal consumption expenditures, the core was sitting at about 2%, 2.5% or whatever it was, but it was coming in line with the Fed. So in an environment where your economy is doing okay, it's growing, beating expectations. At the same time, inflation is moderating, suggests that it might not be the time that the Fed will think that they need to cut rates. And if they're not cutting rates, then real rates are going to stagnate. And that's what they did. They stagnated. When that trend stopped and flattened, that's when gold price took a little bit of a breather. And that's where it's at right now. And so people in December were, predicting 6 cuts in which I thought was aggressive this year. That's shrinking in terms of amount, in terms of the overall, not only the volume of cuts, but the impact of the cuts. So that all impacts gold price because it impacts real rates. And that all comes back down to institutional equity, whether they want to buy a gold equity ETF or not, or that spills over into equities. And so that's where we're at right now with respect to the gold market. But definitely for me, I think the real rates have peaked in the cycle, but the trend still has to be down negative for us, for the investors to take an interest in gold again.
Okay. And you see that as being a little time off because of the way the economy is moving. The Fed is not going to just jump in and lower rates for no reason.
Yeah, well, exactly. I don't think if they're not pushed, there's no incentive. As long as they can get inflation to 2%, they're not going to increase rates anymore. They don't have to. And if the economy is working, then boom, they might be saying, well, there's no incentive for me to do anything, and then unemployment is at a good rate. I don't have to touch it. And if that happens, real rates might flatten. And if they flatten, if we think about it, if interest rates don't change and inflation stays at 2%, then real rates will come down because inflation is still there. But they won't go down as fast. So if you have
the
moderating,
the assumption is that inflation actually gets down and stays at 2%, because I don't believe it's gotten down there yet, has it?
No. Well, the core personal consumption expenditures, which is something the Fed watches as opposed to the CPI, the core had gotten to around 2%. So it's around their number. Whether it stays there, who knows? With everything that's happening in the world, and then we might have another issue with supply chains. Who knows? We might see. But the other thing is that people forget about is labor. So for the time I was with Phelps Dodge in the early 2000s in Phoenix, that's when the U.S. was basically, it pushed out a lot of manufacturing to Mexico, but Mexico's capacity to take manufacturing is nothing compared to China. So as that push went out to China, all those good paying jobs, union jobs for manufacturing in the States disappeared, and you didn't have those kind of jobs. And so, employment, that was never a push on inflation jobs because wages just did not change. And basically the States exported all that inflation to China, and China, modified it somehow with their currency fluctuations and how they worked the currency, and then sent it back here to the States. And they moderated the price such that we never saw that inflation. But if we're asking for manufacturing to come back to the States, which a lot of it has come back to Mexico, but Mexico's capacity is limited. If we want those jobs in the States, we're going to have to expect labor wage rates to come up. And if wage rates come up, then we're back into maybe the 70s and the 80s, as opposed to where we were during the Greenspan times and beyond when we kept interest rates low. That would be next to impossible in the 70s when wages were much more important.
So I want to ask you a quick question on silver. The Silver Institute stated that silver recorded a deficit of 238 million ounces in 2022. That was the highest supply shortage on record. The report further stated that the deficit in 2021 was 51 million ounces. So combined, it wiped away all of the cumulative surpluses from the previous decade. It also predicted that 2023 would finish with 142 million-ish ounces in shortfall. Strangely, the last time silver was in such a huge deficit was 99, when demand outstripped supply by about 150 million ounces. And it took a few years of this, but then the price of silver, I think it was around 2003 or 2004, it began to move higher. And then finally by 2011, it had really taken off. Do you see something similar brewing for silver?
I don't know the silver market as well as the gold market, but what I would say is that silver is like a bipolar metal, in that some of it is linked to precious metals and that kind of demand, and so if gold goes up 1%, usually silver would go up 2%, because it was more of a play on gold, but more levered. But on the other side, the other half of it, and maybe more, is industrial use. So that part is more impacted by industrial production rates now, with the carbon neutral path of the globe. More use and higher intensity use in different carbon neutral technologies. But the problematic for silver is that a lot of the production of silver comes from mines that silver's a byproduct. It's not the main product. And so those mines can produce more or less silver depending on the price of zinc, or depending on the price of lead or copper or something else that has nothing to do with silver. So a lot of the silver sits in a very low cost bracket because people will produce it no matter what the price of silver is. And so even silver companies find the silver market so small that they end up going into gold. So a lot of their production is in gold now, but they still report silver equivalent, but they produce more gold. Because geologically, it's hard to find decent silver dominant deposits. Geologically, there's just not a lot of them out there. Because you'll always have gold with them, or you'll have some other base metals, but the base metal revenue will make the silver just a byproduct, less than 10%. So silver is a difficult market to predict how to play it. Let's just say, if you like silver and you think it's going to go up, maybe taking a silver metal ETF might be the best way of doing it. Rather than equities, because as you dig into a lot of these equities, they don't really have as much silver exposure as you think they do.
That's a good point. I want to ask you a question on copper. Billionaire mining expert Robert Friedland recently stated that copper needs to nearly double to 15,000 a ton in order to just spur on the investment that's needed for new mine development to meet rising demand. He also stated that the rise to 10,000 a ton that Goldman Sachs is suggesting they're seeing is coming. That's not enough to stimulate the industry to take on the risks of building huge capital intensive mines, especially in Latin America.
Yeah.
The mines take approximately 16 years to get to production, and analysts are expecting global mined copper output to fall through at least 2030, creating large shortfalls into rising demand. Can you speak into this for us and how you see this supply-demand situation playing out?
So this is a theme I have bought into heavily in terms of the portfolio within Exploration Insights, because not only do I, because we at Exploration Insights and most resource sector investors, we're looking at almost illiquid stocks that we're playing with. And so sometimes it could be problematic playing in a liquid stock and an illiquid commodity. So what I like about copper is it's a liquid commodity, even though I might play with a liquid stock. So I do buy into this the supply issue. I travel a lot. I mean, I was in Chile, Brazil, Argentina last year, and I gave talks in Chile about the shortfalls they were having. If you look at Codelco, I mean they're producing levels that they haven't seen for like 15, 20 years. And they require a lot of capital that they've done bombs for, but still to recapitalize some of their mines is going to take more money than they or the Chilean government have. And then you got incentive on a lot of these development projects there. Like who's going to give them this $1-2 billion? I don't know. And then even the ones that are building like QB2, Quebrada Blanca 2 Tech, their cost overruns are scaring everybody. Like, is El Abra sulfides going to be built? Is the incentive price there for them? They might think not. And then you have the other problems in Peru. Peru being the second producer, or them in the Congo right now because of Robert Friedland's Kamoa-Kakula mine, is infrastructurally they're challenged. Giving permits has gotten slower. More problematic. Argentina, a lot of projects, a lot of exploration. But infrastructurally, they're challenged because all that production right now is looking like it's going to go east. And they're also, over 5,000 meters, some of these ones, elevation's an issue. So, yeah, it's not easy in terms of looking to see where that copper production is going to come from. And like you said, like it's a 15 to 20 year waiting game to knowing about that project. So if we don't know that project right now, it's not coming in the next 15 years on average. So then we have to look at all the projects out there, and then we could probably start checking them off. Like Pebble is problematic in the States and Alaska to get permitted. They're having a hard time permitting some projects in Arizona. That project that Rio Tinto have, Resolution, the underground copper mine. In 2003, when I was a market analyst, we had that project coming into production in 2010. It's now 2024. So when the USGS initially did not have copper as a critical mineral, they probably were looking at all the resources in the US because the US is pretty well endowed, unlike China, with a lot of minerals. The problem is that they don't want to develop them. So if the USGS actually looked at all those projects and said what actually can get permitted, they'd find out that there's a real problem there, that they don't have what they have, and they don't have any processing capacity. So if they produce a copper concentrate, where's it going to go? Bingham's got a smelter. El Paso, which was Phelps Dodge, is now Freeport's. But who's built a smelter there in the last 20, 30 years? So that's all going to go somewhere. It's going to go to Asia. Then you'll get a car. You're not going to get copper cathode. So I mean, that's the problem. Is these people don't think. They got no idea what they're talking about. They can't go from soup to nuts and think, okay, well, if we don't do this, why are we building a process plant over here when we're not permitting the mine over there? But because they're building a big railway line from the DRC, from the Congo, to go west to Lobito, which is a port facility in Angola. Why? To get the copper out of the Central African copper belt and not use Chinese infrastructure going out east, but taking it out west. That'll take out the copper and it'll take out the cobalt. So I think the U.S. is at least smart enough to know that doing it locally is harder. So if they can go to those countries where it's easier to permit, they'll go there.
So you really highlighted the supply challenges that we have in copper incredibly. Do you see, with the electrification of everything, with electric vehicles, especially in California, being basically forced into law over there, with the rise of the Indian population, over 1 billion people, et cetera, the solar panels, do you see the demand side for copper being equally problematic moving forward?
Well, the thing is, I don't believe the EV story of about 100% penetration. That'll never happen in the States. Like what we were dealing with in Canada, like I've got a hybrid with my wife, and it was impossible to charge that. And then the batteries would drain so quick. But because it's a hybrid, we can still use fuel, but those other people can't. And so problematically, people think about this world that everyone's going to drive an electric vehicle, not thinking about where the power is going to come from, not thinking that there's no infrastructure
Mm-hmm.
to build it, like in a sort of a Barbie world that you can get it from A to B, but nowhere else.
But California has passed a law that says by 2035, all new vehicles will be EV.
Yeah, exactly, and that's why a lot of people leave California. I mean, it's ridiculous to mandate it. I mean, if people want it and it's the right thing to do it. But don't force people to buy it.
But from a non-political perspective, and I'm not saying I agree or disagree, but from a non-political perspective, they're the number one state in terms of the amount of autos on the road. They did pass the law that in about 10 years, it's going to be mandated. 8 other states are following suit. Solar panels are exploding globally, and they use a lot of copper. The electrification of what's happening in India, just bringing those people up to have air conditioning and basic electricity is taking place. Do you see an increase in demand? I mean, we have a decrease in supply. Do you see an increase in demand coming?
Yes, I do see a demand pull, but I'm not sure if I believe all the thematics, especially the electric vehicle one. But I do believe like your solar panels, anything. So the reason I like copper probably more so than a lot of the battery chemistry minerals like lithium or cobalt or even nickel is the battery technology can change like that. If they can't get enough cobalt, they'll manufacture a way to have less cobalt in their battery to none. And now if lithium gets problematic, suddenly you see sodium chemistry batteries coming out that are about 5 years behind. So technology is something that's not constant. It'll change. But once you have to put your foot down one day and say, well, if I'm going to build whatever, 1 million cars, I'm going to have a technology. But in terms of copper, that's the infrastructure. No matter what technology goes in, for it to be conductive, for the current to flow, you need the copper. Mm-hmm. So that's an easier play into this carbon neutral society for me. And I believe on both sides it is problematic on the demand pull and the supply push. I mean, there's just not enough supply coming in, and problematically, some countries like the U.S. are making it even harder to get that production in because of their permitting regulations.
Yeah, and so it sounds like to me, from what I'm hearing you say, is the copper story is not a 1 or 2 year story. It is also a long-term story similar to uranium in that the supply demand situation is going to be extremely difficult to figure out and bring an equilibrium to that market.
Yes, I mean uranium's got another problem with the it's highly regulated, whereas copper isn't, which can be a good thing and a bad thing for the price. But copper, the big problem as well is not only the mines, but in terms of the processing facilities, because the smelters and the refineries, about 40 to 50% are located in China. So if you get your copper from China and that goes in your car, you don't get that half of that incentive to buy that electric vehicle. And that's why everybody is trying to get their countries registered under that Inflation Reduction Act so they can sell into the US market and get that incentive. If they can't, then it can't go into the States because electric vehicle prices aren't low, they're expensive. So people need that incentive to buy them as well.
So for you, do you feel, because of the challenges with the miners, do you feel, with their cost structure and everything, that maybe there isn't as much leverage in the copper miners either, and you want to play the metal more there?
No, No, the problem is that you have to be very specific about the risks that each one of these projects or companies have. Like you saw First Quantum, big copper producer, production in Zambia, which is now turning out to be a good jurisdiction, production in Spain, Las Cruces, and one of their biggest projects was just coming into commercial production, been producing almost a year, and then it gets taken off the market. And that's Cobre Panama, and that's 1 to 1.5% of global supply. Now the treatment charges and the refining charges are heading down because nobody's got copper concentrate for the smelters, because all this stuff that was promised is now force majeure. So that's another thing that's incentivizing for the copper market, is that these jurisdictions are very problematic. And so after spending $7 billion, suddenly you don't have, and being in commercial production for less than a year or something, the mine is gone. So all these other guys are kind of, well, do I build this project over here? Do I do this over there? Because ESG and all this other issues, they're huge, especially if you're putting that kind of money or that kind of capital into the project.
Mm-hmm. Yeah. Okay. Okay. Well, before we wrap up here, I asked Joe the final question. I want to remind everyone that if you're a premium subscriber to our Substack, metalsandminers.substack.com, not only do you get a bunch of free content throughout the week, but you also get our Nugget Notes, which is a downloadable recap summary from each and every interview, just like this discussion with Joe. You get some premium interview content that is not in this current video and is found on the Substack only. And you get access to the Metals and Miners Critical Report Library, among other benefits. If you've enjoyed this conversation with Joe, even half as much as I have, and would like Joe to come back on in the future to discuss more of the issues that we have discussed today, please let him know by hitting the like button, clicking the red subscribe button, clicking on that little bell icon, and leaving a comment below the video. Okay, Joe, in wrapping up our discussion, based on your economic worldview and understanding of some of the supply and demand shortfalls that we've discussed, how do you recommend to the generalist investor that they position themselves overall and within the mining sector? Do you recommend ETFs, playing the metals, the majors, the juniors? Would you please care to speak into this?
Well, I did one of these talks in Rick Rule's royalty and streaming boot camps. And in that, I created a bit of a chart for how to look at different ways of investing, let's say in the gold sector. And that all depends on meaning you as an investor, you, the audience, your risk profile. How much work are you willing to do to understand your investment? So if you're not willing to do a lot and you want leverage to gold, then buy the gold ETF. Just buy physical gold. If you're willing to say, you know what, I think I like gold leverage that the equities provide, but I can't be bothered knowing every company, so I buy an equity ETF. That has a mix of companies and diversified jurisdictions and all that other stuff. But that equity ETF doesn't pay a dividend. So if you want a dividend, then you might have to look at something like a company, and then you might start off with the Newmonts and the Barricks. Then you'll have to understand, what are they in a capital cycle? Do they have to build something? Blah blah blah. Or the intermediates would give you more leverage, but potentially less liquid, higher risk, or then you go into the full psycho mode and you're into the development place, and then you just go ballistic and go into exploration where they don't even make any money. So depending on your risk reward, the higher the risk, hopefully, the higher reward, but it's a lot more work as well to take the wheat from the chaff. If you're not willing to do that, by all means, stay up stairs and just stick with the gold physical.
Yeah, that's good. That's really good advice. Do you see in those investments, when you see a a spike in or a nice long-term increase in the price. Do you see a rising tide raises all boats situation, or do you still see a very selective, depending on the unique situation of the company, the balance sheet, the investment profile, all of that?
Well, last year was definitely more of an alpha market where those single stocks did well for whatever comparative advantage they had over their peer group. If it goes the way I think it may go, that real rates have peaked and then the rates will go down and the gold price will benefit from that, then that would be more of a beta play where, we might have, all boats rising at the same level.
Hmm.
But still with that and still now, it's like I get asked as well, like people that want exposure to the undercapitalized sector that say, I want marginal producers because the marginal producers are the ones that provide me the most leverage. And then they'll ask me as well, what's the one that gives me my downside risk that has the best all-in sustaining costs and the highest margin? So I'll tell them both. So you have a bit of a barbell strategy. So everyone's got a different risk profile and how they want to play it. There's a lot of ways to play it. There's no lack of companies out there.
Yeah. Joe, this has been so wonderful. I really thank you for being so generous with your time, your analysis, your ideas, for coming on and talking to us for the last 55 minutes plus. It's been great to spend time with you. You're welcome back anytime to share with us any updates that you may have on everything that we've discussed in the metals and mining markets. And would you please tell the viewers where they can learn more about your work at Exploration Insights, how they can connect with you, and where you could be found on social media?
So Exploration Insights is a weekly publication, subscriber-based, and so that's how I get paid, is through my subscribers and what I make from my own portfolio. So I tell people what I'm buying and selling. It's got a lot of thematics, rants that we've probably discussed a few here on the interview. There's a lot of free stuff on the website, explorationinsights.com. I do interviews like this one as well, and present at different conferences. Another thing that I do a lot of is site visits, and so that helps me a lot in trying to understand assets, geographies, and getting updates. And so I usually travel at least once or twice a month. Next month I'm off to Australia, and then I'm organizing a trip potentially to the Middle East and East Africa for April. So that all should be very interesting.
Wonderful. Wonderful. Again, Joe, thanks again. Wonderful time. Look forward to talking to you again soon.
Great. Thank you very much.